Good morning, ladies and gentlemen. First of all, I would like to thank the ADBI for giving me an opportunity to speak to you all at the 20th annual conference of ADBI. This year marks the 20th anniversary of a close collaboration between ADBI and the Policy Research Institute of Ministry of Finance. Immediately after the Asian financial crisis, we first co-hosted a meeting by senior officials in the region to discuss the causes and possible future remedies to the crisis. This year, among many other things, two institutions organized the Tokyo Fiscal Forum and discussed recent challenges to fiscal policy under rapid demographic change, which is a common feature among many Asian countries, and shared perspectives for formulating sustainable policies for inclusive growth in Asia. We cherish such productive relationship we have with ADBI and intend to strengthen this in the future. This year also happens to be the 20th year since the Asian financial crisis hit the region. The salient feature of the crisis was that it was not caused by public debt, but from significant amount of foreign currency debt by the private sector. The Asian countries were enjoying rapid economic growth, largely financed by foreign capital. In the case of Thailand and Korea, it was the financial sector, and in the case of Indonesia, it was the non-financial corporate sector that was borrowing heavily from outside. And much of the funds eventually found its way into the construction and real estate sector, causing the so-called double mismatch. And we all know what happened after that. The Asian financial crisis was a wake-up call to the international financial community. First, the IMF had to review its governance structure. It became clear that emerging economies in Asia was underrepresented at the IMF, and realignment of quota became a priority. Second, the deficiencies of IMF program design as well as its instruments became evident. Therefore, new instruments were introduced to meet the new challenges caused by capital account crisis, and the program design was streamlined, limiting itself to macro-relevant issues. Third, the Asian countries realized that it was crucially important to become less reliant on the IMF, to establish a self-help mechanism that made them somewhat independent from the IMF. Initially, the idea of creating an Asian monetary fund was discussed, which eventually led to the creation of the Chiang Mai initiative by the ASEAN countries together with Japan, China, and Korea, which provided additional layer of cushion to the foreign exchange reserves. We also established AMRO, the ASEAN Plus 3 Macroeconomic Research Office, providing effective surveillance to its members, enabling the countries in the region to obtain a second opinion which is independent from the IMF. In addition, the Asian Bond Market Initiative was launched to encourage Asian countries to develop efficient and liquid domestic bond markets, which enable them to raise long-term funds in their own currency. More importantly, all countries in the region put the economic house in order and adopted sound macroeconomic policies with flexible exchange rates. Now, they all have much stronger external positions together with sizable foreign exchange reserves. All these changes made Asian countries stronger and more resilient against external shocks. When the global financial crisis hit the financial markets around the world, this region was relatively less affected, with only a slight dip in GDP growth, which indicated that all these efforts after the crisis was paying off. However, we cannot be complacent. There are a few early signals indicating that the region may have built up some vulnerability in the financial system over the years. First, the amount of private debt stock is increasing rapidly in many Asian countries. In China, for example, the non-financial corporate debt reached about 235% of GDP in 2016 and is projected to rise further to over 290% of GDP by 2022, according to IMF report. The deviation of credit growth from its trend is very high by international comparison, and such large increases have internationally been associated with sharp growth slowdowns and often financial crises. A large part of this debt is assumed to be held by zombie firms, overcapacity companies, and underperforming state-owned enterprises. People Bank of China Governor Zhou recently warned that Chinese companies have taken on too much debt and argued for less financial leverage. But he also pointed out that some of China's corporate debt includes borrowing from financing vehicles owned by local governments, therefore making them effectively public debt. I will come to this issue later. A related issue is a large foreign currency bond issuance by the Chinese corporations. China has become the largest foreign currency bond issuer in the region, with a market increase in the real estate and energy sectors. Although this is not an immediate concern, it can nevertheless put a heavy pressure on the renminbi exchange rate when the corporates find it difficult to roll them over, as it was the case in 2015. Another example, in Indonesia, the increasing foreign currency debt by the private sector has caught the attention of the authorities. They imposed restrictions on new offshore financing arrangements by non-banking institutions, requiring them to satisfy certain minimum hedging requirements and liquidity ratios in relation to their external indebtedness. In Malaysia, household debt remains relatively high, and with rising real estate prices, could be a source of vulnerability. On the corporate side, large foreign currency borrowing by the construction sector warrants close monitoring. In Korea, household debt has been surging, accompanied by rising housing prices, especially around the Seoul metropolitan area. This represents both a short-term vulnerability with possible risks to financial stability and a structural issue, as high debt can depress household consumption and dampen medium-term growth. Next, the local government debt has also become a major issue for some countries. Again, in China, the local government debt has been increasing quite rapidly, and the central bank governor Zhou cautioned that complicated relationships among provincial, municipal, and more than 3,000 county governments creates an opaque system and intensify price distortions for loans and debt borrowed by local governments. He also warned that fiscal policy transparency may not be good enough, and pointed out that there is no clear fiscal discipline to constrain the local governments. The financing vehicles owned by local governments assumed to have close links to the growing and opaque shadow banking industry. And the activities by local governments have fueled the property prices that have reached a very high level in some parts of the country. All these issues are intertwined, which makes it quite a challenge for the authorities to manage the whole situation. The challenge becomes even more complicated as the authorities have to tackle the issue as the Chinese economy is going through a transition from a high growth phase to a medium to high growth phase. And also the efforts by the Chinese government to liberalize their economy, allowing market mechanism to play a larger role in the economy, also creates additional challenge to manage the situation as it becomes more difficult to fine-tune or control the economy. Another example, low PDR. They face quite a different but equally tough challenge with the local government debt. Lack of clear rules between the central government and the local governments about the funding of various infrastructure projects by the local governments have created a huge liability for the central government. Establishing clear procedures and rules, as well as maintaining strict control over the spending activities of various parts of the government, remains a major challenge for them. After the global financial crisis, the central banks of the major economies have engaged in a non-conventional monetary policy, providing liquidity to the market on an unprecedented scale. The Asian countries benefited greatly from steady flow of steady inflow of low-cost capital to the countries. But all these may be about to change. In the US, as Fed has already started to reverse the course of its monetary policy, and the ECB is also likely to follow suit in not so distant future, which could give rise to a possible reversal of global capital flows. When this happens, large accumulation of debt in the private sector and the local governments could potentially pose a major challenge to the governments in the region. As I discussed earlier, the Asian countries have done their homework after the Asian financial crisis, so I believe that the countries are very well positioned to take on this challenge, as is evidenced by large holdings of foreign exchange reserves and having a very flexible economy, including having flexible exchange rates. But nevertheless, it is very important to keep in mind the possible adverse effects that may come from the change in global macroeconomic environment. So this is an opportune moment for us all to review the current situation regarding the debt of corporate sector and the local governments and discuss potential issues and also other way forward. Today, we are joined with experts from various countries, including top scholars, economists, practitioners, and government officials. So we have the best minds in this room today, and I look forward to an exciting and fruitful discussion. Thank you very much.